Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. Now, last week, Julia Lee pointed out that stocks that report well and then are bought solidly after reporting usually do well in the period after. So I've asked Julia Lee of Burn Invest and Dawes of Shaw and Partners to give us their best three stocks that fit this bill of reporting well and the market then buying the stock. Then we've been followed up by the CEO of Tyro Payments, Robbie Cooke. I've interviewed him earlier today. I want to see, the company reported pretty well and the market saw the share price go up over the week. Interesting to see what he sees for the company going forward. Then Paul Rickard will look at some great income stocks he looked at a few months ago to see if they've actually delivered now reporting season has come. It hasn't quite gone, we've got one more week to go for reporting season. But before we start, today, a host of stocks actually pay dividends, and often a payment of a dividend leads to a stock price fall to the extent of that dividend. So if these are any of the stocks that are in your portfolio, their share price might be down today, but it might be because of dividends. I've actually put them here in a table, and I've actually shown you what the analysts think lies ahead for these companies. So Woodside, 29%, Ansell, 21.6%. These are what the stock prices might do in the future. This is the best guess by experts who track these companies. Beach Petroleum up 32%, Challenger down 7%, Credit Corp up 6.6%, Babcorp up 19%, Evolution Mining 5.6% up, Latitude Group 32%, Infomedia 26%, and VGI Partners was not surveyed. So that's it. Let's go to Julia Lee right now and see what her favourite three stocks are out of reporting season. Thanks for joining us, Julia.
Great to be here, Pete.
All right, so this whole program has been basically designed on something you said last week, how companies that report well and the market then buys the stock and likes the stock, they have quite a good history of performing well after that. That's pretty well the story.
That is a story. Reporting season is important because of that reason. And that is that companies that report well, they tend to do well 6 months after reporting season as well. And the reason for that is I think we get an idea around the outlook for the business. So those companies where there is earnings momentum happening, the share price momentum continues onwards and upwards.
Okay. Before I go to you and ask you those three companies, I guess that we do get unusual situations, don't we, where some companies are performing brilliantly because of something unusual like lockdowns, and we have to think, well, in 6 months' time or 12 months' time, will the lockdown advantage be taken away for those companies as well? That's another thing that has to be considered when you look at that general pattern of stock prices.
That's absolutely a great point. And that's one of the things I look at during reporting season. If we do see something bad or good come out, whether it is bad or good, so either sides of the spectrum, I like to ask myself, is this a once-off? Is this something that's going to be temporary? Or is it a forever type of situation? So I guess a big question that a lot of investors are asking themselves at the moment is that those COVID-19 stocks that have benefited, where the peak in earnings is likely to be. I mean, a good example of this was the travel companies. We know that there's been huge losses in terms of the travel industry. Yet last week we saw Qantas's share price up by 20%. We saw Flight Centre's share price up by around about 20% as well. So obviously the market is forward looking, and the big question is, you know, in 1 year's time, looking back on this period, what are you going to wish you had bought?
Yeah, okay. So let's go to the three that have stood out for you.
We had car sales, and I like the car sales result. Importantly, not only did we see momentum in terms of its core business, which is Australia, so earnings was up by around about 20%, but also there were a few changes coming. The direct to customer, which means that dealer groups will be able to sell used cars direct to customer and pay a transaction fee. I think that's really going to expand the market for car sales. It's going to mean that car sales can offer other things to car dealers, which is a major part of its business. So I think that's a positive. A disappointing part was the South Korean market, where there has been a lot of investment, but it didn't really pay dividends. But I think in the current financial year, that's where we're going to see the, I guess, it fruiting, and hopefully it will be good for the the next 12 to 18 months there. So look, I think there's a number of measures in place there for car sales, which means that the momentum will continue. An important date to look out for is its AGM in a couple of months time, where we should get a bit more of an outlook on Traders Interactive, and that's the US platform where it owns a 49% stake. But we know that car sales momentum has been good, and look, a few tweaks in terms of its platform means that I think that momentum is going to continue.
Okay, that's your first one. What's your second one?
I guess having a look across the market, another one that we owned was WiseTech. So that was a great performer during reporting season. And we know that logistics has been very much in focus because of COVID-19. So look, I think all those acquisitions that WiseTech has made over the last 2 to 3 years is now starting to pay off. And of course, given the state of COVID-19, the logistics business at the moment, where we are seeing holdups at ports and also shipping rates just absolutely going through the roof, it means there's a lot more emphasis in terms of understanding the logistics product cycle as well as keeping track of things. So WiseTech doing well there, and liking that result going through. So still holding on to some of those WiseTech shares, although we did take some of that profit when it was apparent that there probably was a bit of short covering on the day, because the shares did surge 50% on the day that they came out with their results. And the last one, I think...
Before you go there, because the interesting thing about WiseTech was that the market was influenced by, I think, at least one hedge fund report and short sellers who really said these guys have bought too much and they haven't sort of culturally synced all these businesses in. I guess it's taken time, but I think the company's proved the doubters wrong.
I don't think short sellers have been having a great couple of years. I mean, if you think about some of the short seller targets for the Aussie share market, there's been WiseTech, there's been Technology One, there's been Rural Funds, corporate travel and all of these companies have been doing quite well. So look, it hasn't been the best type of market for those short sellers, but certainly an interesting one because of that. But I think logistics is very much in the spotlight at the moment, given the port problems, the shipping rates going through the roof, and of course a lot more people looking at ordering things from overseas because we're internet shopping at the moment.
Okay, so what's your lucky third one?
Yeah, I think having a look across the wealth business, Hub24 actually came out with some good results, and it looks like there's some strong momentum in terms of the share price. Probably holding back its business a little bit is where the cash rate is, but as we see the cash rate starting to rise, that should be a positive for its business. So I think it was a very good performer in terms of this reporting season, and I think it's a business that will continue to grow because of the dislocation that we are seeing in the wealth industry, with the big four banks continuing to get out of that space, and of course players like AMP and IOOF also being impacted negatively. So look, I think this is a space that will continue to grow, and the kicker is going to come, I think, when we start to see the cash rates rising.
Yeah. Coming up after you, I'm interviewing Robbie Cooke, the CEO of Tyro, and Tyro reported reasonably well last week and also went up. What's your current view on Tyro?
Yeah, I think Tyro is definitely a part of that reopening trade, and it is seeing a bit of money flowing through. So we are seeing once again a rotation into some of those reopening plays, whether it's Tyro or Essentia, which owns the Westfield shopping centres here in Australia, or whether it's the travel businesses. So I think that's something for investors to keep a close eye on, because if we do see things reopening back up in September, October, and travel once again being on the cards in December, January, that's obviously going to be a game changer in terms of the earnings and the revenue momentum in these companies.
Yeah, certainly when lockdowns are eventually over, a lot of us will be going to restaurants and pubs.
Oh, I can't wait, Pete.
And that's why I think a company like Tyro will be a beneficiary, but we might have to wait a while. Julia Lee, thanks for joining us.
Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer or click on the link in the description below. Well, joining me now is the CEO of Tyro Payments, Robbie Cooke. Robbie, thanks for joining us.
Pleasure, Peter. Lovely to be here.
So last week, Tyro's share price rose all last week, up over 11% for the week, which is always a good sign when a company reports and the market remains positive over the course of the respective week. Some analysts out there think you have 14% upside. Two out of the four analysts on the FN Arena think you have 20% upside. And I know that's not anything that you have any control over, but I guess my question to you is, what are the good stories out there that you're taking to market about what Tyro is going to look like over the next 6 to 12 months?
Good question, Peter. And look, absolutely, bigger brains than mine work out the share price. But look, in terms of what we're doing in the business, and I think we haven't changed what we've said we were going to do since the IPO back in December 2019. But yeah, obviously the business had a few choppy water moments in the last 12 months. So I think we've navigated those well, and I'm happy to talk about those a little bit. But in terms of the business and the opportunity for us, we are quite different to a lot of other payment companies that are out there globally and domestically. So we're competing against the four major banks predominantly for our payments business. And the reason why we believe that we've got a great opportunity in front of us is that we have a proprietary technology platform that drives our payment solution. So we are able to focus on the verticals that we're looking at and produce solutions which are right for them. So, we've been very focused on health, hospitality, and retail verticals to date, and we've managed to produce payment solutions which are bespoke or customized for those verticals. So in my view, so long as we as a team keep on focusing on that uniqueness, we're well placed to continue taking more market share. And we called out in the result, in terms of the card present and card not present market in Australia, we have a 3.8% share of the total market. So there's plenty of opportunity there still to be had, so long as we execute well and we keep doing what we've been well regarded for over the last 19 years, which is building really good payment solutions for Australian businesses.
Now, one thing you wouldn't have had in your business plan 2 years ago was lockdowns. And what was the cost to growth of the lockdowns in New South Wales and Victoria in particular to the company's progress?
Yeah, and look, lockdowns have been incredibly difficult for our merchants, and we are predominantly working with SMEs, and as I said, sort of in 45% of those are in the hospitality space. So really did get impacted. Go back to March, April last year, we saw incredible volatility in our business, and that's reflective of the pain that our merchants were experiencing. So we navigated that with our merchants. We tried to do everything we could do to help our merchants through that period. So we did things like, where people had loans with us, we gave relief from repayments through the period. We did terminal rental free periods, and did everything we could do in our power to help merchants through that. But the thing that we noticed was, as those lockdowns were lifted, business did rebound quite quickly. So I remain very optimistic about the outlook. I know it's really tough in New South Wales at the moment, but I think as that vaccination rate starts getting to that 70% mark and people are let out in the wild again, there will be a pent-up demand there that will come through quite quickly, in my view. But also, the thing that we've noticed, and not for all our merchants, but for a number of our merchants, they've evolved through this process. So a lot of restaurants now, really focus on that takeout piece, and found ways to do that more economically. So rather than necessarily relying on Uber Eats and Deliveroo, etc., they found ways to tap into their existing audience of loyal customers and doing takeaway. So that's been really interesting. I mean, it's not as each order is probably less than they get from a patron in venue, but some venues are getting the same amount of orders in that lockdown period as they would in the normal world. So it's fascinating, right, to just watch how business has evolved and adapted to the change in circumstance. But I'm not for one moment downplaying the impact. It's been pretty significant for a lot of our merchants, and you can see it in our weekly updates we put out to the market, just how volatile.
You've made me recognise that one plus of this lockdown experience has been I haven't been forced to give 10% tip every time I went to a restaurant.
Very true. Although you could still do it now, right?
Yeah, I still could do it, but I'm not. But I must admit, I look forward to the time when I can, quite frankly. You had a problem with a terminal issue. I think it was around probably, Christmas of last year?
5th of January. I'll never forget the date, Peter.
That's right. And then, of course, you had what you later described as an unfair hedge fund report, where you nominated 10 mistakes that that hedge fund report made, but the market was informed, I think 11 o'clock on a Friday, I think it was, and you were clobbered. Has that, A, have you gone top of all your technology issues, and B, what's your view on what hedge funds can do to a company?
Yeah, well, two great questions. Look, in terms of the event, I mean, it was a connectivity incident with some of our terminals, and it was on one bit of kit that we don't develop ourselves. So, but that's not an excuse, right? At the end of the day, we leaned in and we did what we said we'd do, which was number one, get the 19% of our merchants who were impacted fully back up and running as quickly as we could, and so that was a prime focus of the team, and that was all encompassing. And then, as we called out when it happened, our focus for the second half is going to be just making sure that we did the right thing, that any of our merchants who suffered a financial impact from that event, we invited them to register with us, and we've worked through their claims. And I'm pleased to say, we've got 85% of the people who've lodged claims with us resolved, and we're working on the balance at pace. So that was a tough period for the business, and definitely, 18 years of running, never had an event like that. So it really did rub against the grain for the whole team, and it was something, was really uncomfortable for us. And we've now got our dongle solution in development, which will provide an extra failover point for merchants. So that's an industry first move, and so we're really pleased with doing that. Look, in terms of the short seller attack, the market, that's part of the market, right? I mean, and anybody's entitled to have a view on a company. So I've got no gripe with that. And whenever there's a buyer, there's a seller. So again, don't have a problem with short sellers. I mean, that's just part of the dynamic of the market. Apologies for the dogs in the background, the joys of COVID. But the thing I had an issue with was just that we had such a amount of errors in that report. And that's the thing, you've got that moment in time where you've got a report in market and you're trying to deal with it and respond to it. And that made it very difficult for us.
Yeah. Well, let's just hope in the future, we in the media are a little bit more careful about reports from that particular group of people. Anyway, let's go to the next one. The big positive stories ahead, obviously reopening, end of lockdowns, all very good. Are there any other stories that people should take on board, which might explain why some analysts have a very positive view on the company?
Well, look, a couple of things. And I think we announced that we did our alliance with Bendigo Bank back in October last year. And that's been a big piece of work. So a large amount of technical work and operational changes to accommodate that. So that's something super proud of. It brought 18,000 new merchants to the Tyro portfolio, so large. And in terms of transaction value, that represents on an annualized basis an extra $5 billion in transaction value. So end of FY20, we're doing about 20 billion. So and we grew organically to 25.5 billion for FY21. In that $25.5 billion, there's about 440 million from Bendigo, so 1 month of Bendigo. So that's a large piece of new business in the portfolio. So we're very positive about that, and that's been a transformational piece of activity in the business. The other one, which I'm very excited about, is the Medipass business, which we bought in end of May. So Medipass was a health fintech. And they basically developed some very good tech in terms of digital claiming for health practitioners. So whereas Tyro had been very effective in the card present piece for private health insurance and Medicare Easy Claim, what Medipass has done is the card not present piece, so sort of e-commerce, if you like, claiming, and very much focused on other funding avenues. So things like workers' compensation schemes, so WorkCover Queensland, iCare in New South Wales, NDIS. So quite a large amount of health is funded through those alternate funding channels, which we didn't have a presence in. So bringing Medipass on board and combining our health business with the Medipass business so that we've got a much more fulsome set of claiming rails, if you like, for health practitioners, puts us in a position where I think we can develop the leading health claims and payment solution for Australia. So that's exciting.
Yeah, and it's certainly a growth industry, the health industry. So that makes a lot of sense. We presume that and you've already inferred, New South Wales, Victoria has been hard for the company because of lockdowns. What have the other states been like? I know I was lucky to escape to Port Douglas for a week before New South Wales went into lockdown. And there was a lot of spending going on there by me. A lot of people couldn't get to Port Douglas because Victoria was in lockdown. But have the other states become, have they shown growth, those other states?
Yeah, look, and again, it's interesting when you look across the portfolio, because New South Wales is normally our largest state by transaction value. So normally would be around about 42, 43% of our transaction value. So for FY21, it was about 37%. So it dropped down a bit. Our most strongly growing states in terms of growth rate were Queensland and Western Australia, both around that sort of high 39, 38% mark. So the states that did, sort of quarantine themselves and haven't had lockdowns, unsurprisingly, have seen stronger growth rates. But bottom line is, as I sort of said before, once New South Wales frees up again, there will be such pent-up demand there that I think you'll see, nice recoveries across the whole portfolio.
Okay. Now, this is just me thinking out loud here, Robbie, and you probably might want to dodge it. But when I saw the Square Afterpay thing happening, I thought to myself, why wouldn't Tyro and Zip think about getting together? Because, Square is a rival for you and Afterpay is a rival for Zip. Have you guys started thinking about that at least?
Oh, look, Peter, I couldn't comment on anything we're looking at. But look, I do look at the Square Afterpay transaction. I don't normally comment on what competitors have done, but I think in terms of the US opportunity for Afterpay, that is a phenomenal partnership, and I think it'll work very well for them. I don't particularly see it changing the payments dynamic for us in Australia. Right.
Okay. Good answer, Robbie. Nicely sidestep. The Broncos might hire you for the 5'8" role next year. But on the point of Square, because Square is a rival of you guys, what do you think is your competitive advantage over Square here in Australia?
Yeah, and look, the payments business is hyper competitive. I mean, there are a huge amount of competitors. So if you don't like the heat, get out of the kitchen, I'd say. Look, and I enjoy the competitive nature of payments because it absolutely keeps you on your toes. In terms of our solution, because we are an Australian business and we're focused on Australian companies and we're building solutions that are right for Australian SMEs, that is a big point of differentiation. So that's one aspect. The other one is that we work agnostically with 320 different point of sale system providers, which is something that's quite unique compared to players like Square who have their own sort of point of sale solutions. So that's different. But look, we are absolutely competing with the four major banks, Square, and there's a raft of others that we compete against as well.
Okay. One final question. You have a banking license. You do provide banking services to small business. Is there a goal that you become a major influencer and supporter of the small business community generally, not just providing payments, but all the other stuff? I've seen some of your ads, which surprised me. It looked like you were sort of saying, we can be more than just a payment solution to small businesses. Is this a long-range goal or a current goal?
Look, absolutely, in the sense that we do have a full banking license. Our point of differentiation, though, we don't see ourselves as fully banking an SME because, look, we appreciate the fact that most SMEs probably have got a mortgage over their home, and that's probably with one of the big four, or a regional bank. And that's not the space we play in. But where we can provide banking solutions that are different, we will. And really for us, it's about providing ancillary products around that payments relationship. So if we can provide like our merchant cash advance loan, which is a great product and really built for SMEs, so that's something that's quite unique. The majors don't provide a product like that. So if we can provide banking products which are really going to help SMEs, we will. For example, our transaction bank account, fee-free, interest-paying. That's something that's quite refreshingly different from what's out there in the market at the moment. So they're the sorts of things you'll see us do more and more of as the years go on.
And do you think you've done a big effort in marketing those really good products to the wider small business community?
Probably not as well as we could to date, but we've done our team's done an amazing job in building our brand awareness out. So it's sitting now at 20% on a prompted basis. So that jumped from 14% a year ago. So that's great. But I still think there's a lot of opportunity for us to A, build out those banking solutions, and B, to get people more widely aware that we have them, for sure.
Robbie, thanks for joining us, mate, and good luck with the year ahead. I'm not only an interested observer, I am a shareholder as well. So I'm really happy that you've come back from that shellacking from the hedge fund earlier this year.
Thanks, Peter. Enjoyed it. Thanks for the time.
Cheers. And that was Robbie Cooke, the CEO of Tyro Payments. Now joining me is Adam Dawes from Shaw & Partners. Adam, how are you?
Very well, thank you, Peter. Yourself?
Very good, mate. And I asked you to nominate 3 companies that you thought had reported well and the market liked what they saw and the share price went up. There's a bit of a history there, isn't it? Those sort of companies often do have a good period after reporting.
Yeah, absolutely, especially in earnings upgrade or in an upgrade cycle.
Yeah, okay. So let's go for those 3 companies that you think really fit the bill.
Yeah, look, the first one that I wanted to talk about was Domino's Pizzas. And look, that has certainly done very, very well after their results, mainly because of everyone's stuck at home. What are we going to do? People are sick and tired of cooking, and they might as well keep the kids happy by buying a couple of pizzas. So, yeah, I think Domino's has done very well. They've strategically placed themselves in that no contact, easy to afford, those kinds of things. And that's doing really wonders for their business. So that was the first one that I liked for that upgrade cycle. And the stock has gone higher since they've reported.
But I guess some people will be saying, right, this was a company that I think was around $60. And I think Don had some issues, family issues, and their price went down then. I think only for about 1 year, but then it rebounded brilliantly, and he's kept on driving that company higher. But the share price now, what is it,
150, 155, something, yeah.
And I'm thinking to myself, well, if we get out of lockdown eventually in 2022, will the market say, oh, well, we won't eat pizza as much as we did, therefore it may well come off the boil?
Potentially, yes, absolutely. That is absolutely fair. However, these guys very much are very technology driven, and I think that's what separated themselves from a lot of the other pizza delivery people, Crust and these ones. But also it's their store dominance that they've got. They're around sort of most corners. They actually place themselves quite comfortably in lower socioeconomic areas also, because their pizzas are quite cheap. I mean, there's only 2 or 3 toppings in a bit of dough, but that kind of stuff I think works well for people. $5 pizzas, I think it sits well in any kind of environment, whether it's good or bad. So look, I think Domino's should continue to do well. It's a very well-run business. And plus, they've got those international arms of Japan. They've talked about other areas that they're expanding out to. So I think that will definitely drive revenue also.
Yeah, they keep expanding in those unusual areas like Japan and France and Europe. A lot of people are surprised, but it's the Australian master franchisor that actually has got these different territories. I think they're probably showing the Americans how to do it, quite frankly.
Maybe.
Let's go to the second stock you like.
Yeah, James Hardie was my second stock. I think this one is a fantastic business. They have had their checkered past, as you potentially might well point out. But I think certainly James Hardie, with an upgrade that they came from their US business or their building and manufacturing business there in the US, has absolutely kicked a lot of goals. Now, we've seen other companies like Boral try and go overseas and come back with their tail between their legs. Adbury, which is Adelaide, Brighton, ABC, they haven't done so well in that space, but we've even saw some building downgrades come from the Australian-centric ones just the other day. So I think James Hardie is a really standout business inside of that, especially for that US growth and especially for the ability for them to run their business. So yeah, there's another one that has done very, very well after the result.
Okay, let's go for your third one then.
This one's a little bit different, Peter. I thought I'd throw something in there that's a little bit more environmentally friendly, minus pizzas and cement and building materials. But this one is called Calix. Calix is a business where it takes heat out of manufacturing, heat out of cement manufacturing to be exact. And there's a lot of other uses for it. But certainly Calix is a small speculative stock. We've got a buy on it, Shaw and Partners. That's one did upgrade when they reported a couple of days ago, and the share price has continued to go higher on the back of that. I think the ESG theme plus the royalties that they'll get from some of these European operations, I think is a fantastic one. We've got a buy on it, and I think it's it's a great business.
What's the ticker code for this one?
CXL is the stock code.
Is it a moderate-sized company or very
small?
No,
we're in the small speculative area of the market there. So buyer beware on that one. But they have some really great royalties coming through over the next 2 to 5 years, and that should definitely underpin the share price.
Okay, so they're the three that have stand out. What else do you have you liked in reporting season?
Likes. I mean, it's probably, if I could do the likes as well as then the dislikes. But the likes is absolutely the dividends that the companies have been bringing back to shareholders, and we certainly saw that with Fortescue, BHP, Rio. Fortescue putting a $2.11 dividend today, absolutely fantastic. And we knew those dividends were going to be strong, and we've talked about that on the show previously. But I think overall the amount of capital that is going to be returned, whether it's a buyback from Woolworths, there's been a fair few buybacks going on. Capital return, Wesfarmers doing a $2 capital share return back to shareholders, or the dividend has been lifted. And I think that's one of the likes that I've thought about this reporting season is that extra dividends that have come through into the market.
Yeah. So it has two effects, doesn't it? On one hand, it's great for the economy. People feel wealthier, but a lot of the investors reinvest, don't they? So it should help the stock market as well.
Absolutely, as well as shareholders' balances as well, as it just nicely ticks higher as you get those incremental dividend repricings going, or DRPs that are coming back into your book. But yeah, the dividends have just been unbelievable, especially in the resource. Even the banks have done well. They come back to sort of normal dividends. And a lot of the larger stocks really rewarding shareholders for their patronage, as it were.
Well, Adam, thanks for joining on the program. See you in a couple of weeks' time.
Take care.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. And that was Adam Dawes from Shaw and Partners. Joining me now is Paul Rickard of the Switzer Report. And Paul looked at a number of what he thought was good income-paying stocks in the past, and he's checked out how they've performed since he's given them the nod. Paul, thanks for joining us.
Thanks, Peter.
Okay, so you've done a bit of a study on some really good and reliable income-paying stocks. Have they remained reliable? Have they kept on paying well?
Well, they have, Peter, and I'm proud to say that looks like the stocks they came up with have done very well. In fact, they've all reported in the last couple of weeks. I thought I'd just double check to see what we found out. The interesting thing about it, Peter, and I looked for stocks that are outside the banks and Telstra. I looked for stocks that were in sort of, not blue chip, but top 150 style companies, typically companies that have a reasonably good dividend yield, usually franked, usually fairly low volatility. So I think of income stocks as hopefully stocks that don't move too much from the capital side. Probably means you don't make a lot of money, but you get that certainty of the payout. And I came up with 5 about 2 months ago, just before just at the start of the financial year. I wanted to see how they'd reported. And in fact, what was interesting, Peter, is that they've all done better in terms of their dividend than was forecast, which is not some just by a fraction, but that was encouraging. And secondly, maybe this reflects the market, maybe it reflects the brokers, but the valuations in each of the stocks has also increased. So the consensus target price in each case has gone up over that period.
Okay, why don't you give us three of them, and if people want to get the whole fired off, go and read the Switzer report.
Well, the first one you may not think of an income stock. This, of course, is Amcor. Now, Amcor's a global packaging business. Traditionally, it's done really well in terms of on the growth side, but if you actually look at its share price, Peter, it's actually reasonably unvolatile by market sense, and also hasn't been doing a lot. In other words, it's been trending up, but not a lot of downside risk. Amcor reported really well, and as a result of that, the market took it a couple of dollars higher. It's now in the 17s as opposed to the 15s. The report was pretty much as expected, but they came out with a fairly bullish forecast in terms of next year's target increase in earnings per share. They said that they had a lot of cash, they were doing a buyback, all the things you'd want from a company involved in packaging. And Amcor is probably a global leader in its space, Peter, and a reasonably attractive dividend yield. Now, it is unfranked, but it's one of the stocks with paying a better yield, reports quarterly because it's a US company. But the analysts like it, and they've all quite considerably raised their target prices. So I thought Amcor's got quite a bit of value still in it. All
right, for those people listening who say, well, what did they actually pay as a dividend? What year?
Yeah, look, it's about 62 cents. And that was on a share price of about $15. That's about 4%. Now, the share price has gone up now to about $17.50. So we're sort of around about 3.5% level. That's unfranked, but paid quarterly, pretty reliable. I guess in their business, there's a lot of efforts going into, sustainable packaging, because that's obviously a big trend as a lot of pressure around from the whole ESG and particularly the environmental side. And Amcor's, one of those beneficiaries of a stronger global economy. Plus, it's got a great client base and reasonably, because a lot of it's involved in food and food packaging, doesn't shift around too much if you get into a bad economic cycle. So that's why I think they're a stock you could almost look at like an income payer.
Yeah. So, and in a world of online purchasing, which has escalated since the coronavirus, they're really well placed to service it. Paul, what's your second one?
Well, the second one is probably the other extreme. A company I've liked for a long time, Medibank, Peter, as you know, not because I'm a huge fan of health insurance, but the actual health insurance market in Australia is pretty measured. It's got a lot of headwinds. It's also got tailwinds. And the thing I like about Medibank in a pretty unexciting, unglamorous type of industry is that Medibank has been growing market share. Now, there are about 40 health insurers in Australia. Medibank has is the lead biggest player with a market share of about 27%. That's not bad when there are 40 players. And to increase market share says you've got to be doing something right. And Medibank it's been growing policyholders, and it's actually been reducing its operating expenses. And as a result, its underlying health insurance profit was up. Share price has gone a lot higher than I expected, Peter, up to about $3.50. When I looked at it just a couple of months ago, it was just over $3. Fully franked dividend yield, about almost 13 cents a share is forecast next year. That's putting it on a yield of about 3.6% fully franked. Not the most exciting of industries, but I think when you're the market leader in a pretty regulated industry, to grow market share even by that much, you've got to say that management is doing something right. And that's the sort of company I like to back.
Okay, let's go for your third one.
Yeah, look, again, I looked at different fields, and I'll go into the property field this time. That's the Charter Hall Long WALE REIT. Now, WALE is WALE, stands for weighted average lease expiry. What that means is that the type of buildings it owns and the tenants it leases out to all do for a very long term. So the type of things it has are things like it owns as the landlord telephony exchanges, right? And it leases them back to people like Telstra. It owns a lot of service stations. It owns a lot of convenience stores. There are other sort of assets, like storage assets that are all done on a really long-term lease. Warehouses to really good clients like Woolworths and so forth. And so it's from Charter Hall. It's about a $5.6 billion REIT. It's been going up steadily. It's very well diversified. It's paying a distribution yield of about 6%. That's unfranked, but a lot less exposure to not so much the commercial sector, more towards the people that take property on a long-term basis. I think it's pretty attractive and it's trading around NTA. So I think there's a bit of value in that. Maybe it's a stock you buy in market weakness. It does tend to be very low volatility stock if you look at the chart. So that's the third I'd nominate. That's the Charter Hall Long WALE REIT. Okay,
so if anyone wants to read the full story and get the other two, they should have a look at the Switzer report. They can do a 21 free day trial. And if they like it, great, fantastic. Paul, thanks for joining us.
Thanks, Peter.
And that was Paul Rickard of the Switzer report. And that's the show for this week. And if you want to get more detailed analysis of stocks that look promising, go to switzerreport.com.au. And by the way, no one on this TV show has paid to present or promote their products. I've selected smart, experienced people to share their knowledge of stocks and the markets. Nothing on this show is meant to be advice, but we hope it's educational, helpful, and ultimately rewarding. And by the way, we won't be doing the show on Thursday because we have our conference, our listed investment conference, over Thursday and Friday. Maybe we'd like to go to that. Just go to the link on the description on the screen. I'm Peter Switzer. Thanks for joining me.